So this is the home office deduction. I need a black. It's easier to see. So the business home office deduction is a deduction that individuals can take when they're self-employed. You cannot take it if you're a W-2 employee, which is really kind of crummy because we've got so many people working from home now. I would have thought that this is one of those areas like where they increase the deduction for the meals, but they didn't change this for individuals working at home. It used to be when you were a W-2 employee, you could deduct expenses if you were working at home, but you can't do that anymore. You can only do that if you are self-employed. So this is when you use your home. You maybe have a home office, or you use it for storage of inventory, that kind of thing. So the home has to be the principal place of business or a location where the taxpayer meets patients, clients, or customers. So it's got to be one of those two. The space that is used for the home office has to be exclusive, so only used for the home office. That's it, no other use. You use your dining room table to do your work, take your laptop out there, but then when dinner time comes around, you clear it all off and then you have dinner at your dining room table. That is not exclusive use, okay? Even if you use your dining room for your home office every day of the year, 364 days a year, but then on Thanksgiving Day, you clear it all out, you use your dining room as an actual dining room, that is no longer exclusive use now. So the use has to be exclusive. It does not have to be a separate room. It could be part of a room, but the use has to be exclusive. So it makes it a little bit difficult to meet that exclusive test. Like if you had a guest bedroom that you then used as your home office as well, you use it 51 days of the year as your home office, but then 51 weeks of the year. Then 1 week of the year you have guests and they stay there. That makes it pretty difficult to say that that is now exclusive use, even if they don't even go into that space. But now you don't have access to it while they're in there, right? Unless you create kind of a separate space. So sometimes it's really difficult to meet that exclusive use criteria. So it has to be, what is it here? And it has to be regular. I'm just looking at where they say regular up here. Exclusive, regular, okay. And regular. So you have to use it on a regular basis. So if you've got a home office that, even if it's exclusively used as a home office, if you only use it a couple times a year or a week here and a week there, it's not regular use, right? So they're pretty stringent about the rules with regard to home offices because, I mean, quite frankly, you can abuse it. It's pretty easily abused. And with the home office, when you do have a home office, you are allowed to deduct expenses that would ordinarily be personal expenses and you wouldn't get to deduct. Okay, so that's why they're pretty stringent about whether or not they allow that home office deduction. So let's just say, for the sake of argument, we do have a home office. Well, how do we calculate expenses? How do you value that, the expense of that home office? What you have to do is you have to apportion the square footage of the home office space that you're using to the relative to the entire house. So let's just say for a minute we've got a home and it's 2,500 square feet. And then we have an office space. It could be 2 rooms too. It doesn't have to just be 1 room. It could be 2 rooms that you're using. Maybe you sell stuff on Amazon and you need to keep, you've got in your storage area, you've got inventory that you keep on hand. And then you've got an office space where you actually do the selling and everything. That's fine. You would include both square footages. And that as long as it's regular and exclusive use and it's part of your trade or business. Let's just say our office is 500 square feet. What we're gonna do is divide it. So 2,500 divided by 500, that's 20%. 20% of our expenses, of our eligible expenses, are our eligible home expenses are attributable to our home office. And now our deductible on our Schedule C. Now there are limitations, which you'll see in just a minute when we go through the actual calculation. What types of expenses would be included? All right, well, we've got mortgage interest, real estate taxes, repairs, insurance, utilities, and we have depreciation. Oh, that's a squeaky pen. We got more than that as well. Generally speaking, utilities would not include water unless you are using water in that business. Most businesses don't, I mean, except for go to the bathroom. Most businesses don't use water actively in their business, but you need electricity, you need gas, all that kind of stuff. So that would be included in here. Home phone is also not included. Like a landline that you then also use. Do people have landlines? That you also use for your business, that cannot be included. A cell phone though would be separate, but the cell phone would be on your Schedule C. You wouldn't put it on the home office. If you have a dedicated line though to your business, that would be deductible. Now we have two different types of, let's see, repairs. I'm gonna add maintenance in here too. Repairs, maintenance. Yeah. We have two different types of expenses. We have indirect, those expenses that apply to the whole house. And we have direct expenses. Expenses that only apply to that area of the home. For indirect expenses, we have to allocate those expenses, right? We'd have to use the 20% in our example. For the direct expenses, we take 100% of them. Example of direct expenses. Let's say we decide that we want to, or we need to paint the home office, but we don't paint any other area of the home office, of the house. We just paint the home office area. That's a direct expense. It's only involving the home office, right? As opposed to, we get somebody in there and we're painting the whole house. That's an indirect expense. Now we're gonna take 20% of the cost of that painting, right? Unless they don't paint the home office, then we wouldn't take any of it, right? Mortgage interest, real estate taxes, insurance, utilities, these are generally indirect types of expenses, right? They're gonna apply to the whole area, unless you have some sort of separate mortgage for the home office area or you've got maybe I don't know why you'd have taxes that are specifically for that business area. But, so these are the two types of taxes. So let's just say we've got mortgage interest, total mortgage interest of $10,000. Real estate taxes, $2,500. Maintenance, let's see, $500. Repairs, $250. Insurance, $2,000. Utilities, $4,500. I'm gonna need your calculators here. And depreciation, we'll talk about depreciation in just a minute. So mortgage interest would not be would not be a direct expense, it would be an indirect expense, so we're gonna take that times 20%. So we get 2,000 of expense for the mortgage. Real estate taxes, again, indirect, we're gonna take 20% of that, and we've got 500 for the home office. Maintenance, now we're gonna have to kind of think about this. If we've got a client that has just maintenance and repairs listed down, you'd have to ask, okay, well, what was done? Was it done just to the home office? Was it done to the entire house? We'll say that the maintenance was just on the home office. So we would take 100% of that. We get that as 100%. Same with the repairs. We repaired, I don't know, we painted the room. We'll call it a repair. So we're gonna take 100% of that. Okay. Insurance, that's on the entire house, so we're gonna take 20% of that, which is 400. Utilities, again, that applied to the entire house. We're not including water in that. That's just gas and electric. We're gonna take 20% of that, which is what, $900? All right, so we've got all of our expenses up here before depreciation. Okay, depreciation, we are only going to depreciate this portion of the home office. We don't get to depreciate our for personal purposes, only for business purposes. So we're gonna depreciate 20% of the office itself. Okay. Now what you would do to figure that out, and again, so this is going to be over 39 years because it's not residential, it's an office. Even though it's in a residence, it's being used as an office, so you would use that 39-year depreciation method, or asset class life for depreciation. So let's just say our house, basis of our house is $250,000. Well, remember, a house has land attached to it, right? We gotta take the land out of our total because we can't depreciate land. And our land isn't part of our home office, most likely. So let's just say 50,000 is attributable to land. So now it's 200,000 is our total house. We're gonna depreciate 20% of that. Right, so $40,000. That's the basis of our home office. That's the part that we're gonna depreciate over 39 years on the straight line method. Okay. So, and I'll show you how that works here. So our total, so if you divided that by 39, so it's gonna be 1,000 and something, right? How much is that? How much? 1025? Alright, so here's our 1025, and it could be, if we did 40, whoops, that's not right.
Can you actually change the 5 to 6?
6?
Yeah.
Can't remember on the form of mortgage interest is kind of listed, or depreciation is listed in a separate section. So that's why I'm like, okay, direct or indirect, we'll just put this down as 1026. So our total expenses here, we'd have $750 for those direct expenses, $2,500, $3,500, $3,800. Okay. So all of these together, 750, 1026. This would be our home office, total of our home office deduction. Now, there are some limitations on this. 715, so 5576 would be our total home office deduction. As long as we had net income from self-employment of at least 5576, we would get to deduct all of that. It gets a little tricky when we have net income that is not at least 5576. We have a specific order that we have to subtract these expenses, and I'll show you what those are.
Where did the 39 come from?
That's 39-year
Okay.
depreciation. Yep. So this deduction limit that I was just talking about, we kind of divide up, we've got to go in order of what we deduct first. Now these items here, we would be able to deduct these on our Schedule A, right? If we didn't have a home office, we'd be able to deduct these 100% of them on our Schedule A. So they come first. Those are the first things that we get to deduct. If we still, once we deduct those, if we still have net income, then next up are these types of things that we get to deduct. If we still have net income after deducting those, lastly, we get to depreciate it. Okay, so they come in, so this is first, second, third. But mortgage interest, real estate taxes, casualty losses as well are listed under there, but you don't see those very often. But those two would come first. Now, how do you handle that? When you've got, okay, let's say we did have net income to absorb the mortgage interest and the real estate taxes, we've taken 20% of those costs as a deduction here. That means we don't get 100% on our Schedule A, right? We have to allocate it between the Schedule C and the Schedule A. So on the Schedule A, we would take 80% of these expenses. So now for mortgage interest, we'd have an $8,000 deduction, and for real estate taxes, we'd have a $2,000 deduction. We're not going to deduct any of these other items on Schedule A because those are personal expenses, right? So, but for these, we would divide it up between the two schedules, okay? Let's look real quick at an 8829. See what that would look like. 8829 is the form that you use to, well, actually, we can look at this example here. So, Rob had $19,000 of gross income from his home trader business. He also had these expenses: $12,000 in trader business expenses, mortgage interest, real estate taxes, utilities, insurance, repairs, depreciation. So expenses allowed, we would calculate this. So this, we didn't do this. He's got a 3,000 square foot house, 1,500 of it is used for business. So 50% business use. So we'd start with the 19,000, his gross income, minus the 12,000 to get to his net income. Right? Whoops. 1,200. Well, 7,000. So $7,000 of net income. First things we would deduct are interest and taxes. The business portion of those. So in this case, they've done the math for us, 4,900 minus 600. Okay, so we got $1,500 left over. We can only deduct $1,500 of the other expenses. So in this case, his utilities, so let's see, so utilities, 1,500 total, 1,700 for insurance, repairs, 2,000 divided by 2, well, we're over the 1,500. He can deduct 1,500 of them, but no more than that. It cannot bring you below zero. So the home office deduction can reduce your net income on your Schedule C, but it cannot reduce it below zero. It can't give you a loss. Okay? So let's take a look at the 8829. example of above, that's a little fuzzy. Let's actually get. Okay, so at the very top here, we would have the area used for business. Okay, so in our example, 500. Total area of the home, 2,500. Whoops. Divide line 1 by line 2, 20%. Don't worry about this stuff, this is for daycares. Daycares have some special rules. 20% goes there, okay. Enter the amount from Schedule C, line 29, that's our net income. So recall, Schedule C looks like this. Line 29 is right there. That's our tentative profit or loss. So let's just say we've got $8,000, okay, of tentative profit or loss. So that's the amount we're gonna put here, 8,000. Now, see, you've got a column for direct expenses and a column for indirect expenses. I had mine reversed up there. So we've got deductible mortgage interest. This is an indirect expense. Real estate taxes. Alright, add the lines together. Multiply it by this percentage up here. So we're at 2,500. Alright, line 14, add line 12 and line 13. Okay, this was if you had any direct expenses, they would be listed here. We don't. Alright, subtract line 14 from line 8. This is to see if those first two, the mortgage interest and the real estate taxes, exceed the amount of net income. So, nope, doesn't, so we're good. What is this, 5,500? If 0 or less, enter 0. So that's telling you right there, you can't go below 0. Now, we've got some other expenses. This is the next category of expenses. Let's see, repairs. Now, in our case, they were, and they put repairs and maintenance together, these were direct expenses. Insurance, 2,000. Utilities, 4,500. I think that was it. Okay. Add lines 16 through 22, 750 and 6,500. Multiply line 23 by 20%. Okay, so that's, what is it, 1,300? Carry over from prior year, so you do get a carryover if you weren't able to use it the last year. We don't have that. So now, add line 23, column A, and line 24 and line 25 if you have it. So just, for us, it's just those two lines, so 2050. Alright. Allowable operating expenses, enter the smaller of 15 or line 26, okay, that's it. Go. Subtract line 27 from line 15. So 5,500 minus 2,050, let's see, 3,500, 3,450, did I get that right? Alright, now the depreciation. Depreciation can be included down here, homes adjusted basis, value of the land. Oops. So 39 basis of the building. Business basis of the building, we're gonna take 20% of that. And then the depreciation percentage, whatever the current year's depreciation percentage is, I don't know what's here and on line 30 above, okay? 30, depreciation. Great. Add lines 29 through 31. Got no casualty losses. Add lines 14, 27, 14, 27, and 33. Add lines 14, 2,500. So 2,500 plus 2,050. 40,550. Casualty loss. Allowable expenses, subtract line 35 from line 34. Is that right? 1026, what did I do? Allowable excess casualty loss. Enter the smaller of line, here, I missed this. Love line 28 or line 32. Alright, so it's 1026. So this number's wrong here. Allowable expenses. Here. 5576. Now we're gonna transfer this over to the Schedule C. Right here. And we would subtract it from the 8,000. 24, 24. Okay? That's how the business use of home works. Questions about that? Okay. Business bad debts. Let's talk a little bit about this. Actually, we don't really have to say very much about business bad debts because we are cash basis taxpayers. We only get to claim a deduction for bad debts if we're an accrual basis taxpayer. So bad debts. What's a bad debt?
I doubt that's bad.
What's that? What'd you say?
I doubt that's bad.
A debt that's bad. That's a great definition. Thanks. That's helpful. So, bad debts, you know, somebody promises to pay you something and then they don't in the course of business. It's an accounts receivable that you don't collect on, right? Well, for tax purposes, for Schedule C, very rarely do we have accounts receivable. We are cash basis. So we're not going to have accounts receivable. We're only gonna claim income when we actually receive the cash. So therefore, we never claimed the income as cash basis taxpayer. So we don't get a deduction for those bad debts. One of the guiding philosophies of taxes is for every deduction that you can take it because at some point the income you used toward that deduction was taxable income. So in this case, you never had the taxable income in the first place, right? So you can't claim a bad debt expense because you never had the taxable income. Okay, so hardly ever use this. The only time you use this is for accrual basis taxpayers. Business casualty losses are treated a little bit differently from personal casualty losses. Remember, we had to go through that whole convoluted calculation for casualty losses. We had to subtract, we subtract our insurance proceeds, and then we've got to multiply our AGI by 10%. We gotta subtract that amount from it, and then we gotta subtract that $100 for each event. We don't have that in business. We don't have that 10% of AGI. We don't have that $100 that we have to deal with. We do still have to take into account insurance reimbursement. But when business property is lost in a casualty, the taxpayer will receive an ordinary loss deduction for the basis of the property unless the property is only partially destroyed. Okay, so if the basis of the property is $100,000 and it's destroyed completely, you get a loss of $100,000. Now this business casualty losses do not go on the Schedule C. They go on a separate form, the 4684, which then transfers directly over to the 1040, which means this will not reduce self-employment tax. The casualty loss will not, because it never shows up on the Schedule C as an expense. Only expenses that show up on the Schedule C will reduce self-employment tax. So with partial losses, if it wasn't a full loss, the loss is the lower of the decrease in fair market value before and after the casualty, or the adjusted basis, so whichever is lower, and all losses would then also be reduced by insurance proceeds. So in my original example, we had a total loss, $100,000. If we got back $80,000, our loss is $20,000 now, not the $100,000, right? If our insurance proceeds actually exceed the basis of the property, which could happen, right? If the insurance proceeds are gonna reimburse you for the fair market value of the property, and it's appreciated in value, but your basis is lower, so we bought it for $100,000, we've been depreciating it, everything, and all that, so now it's like worth $80,000, but fair market value is $300,000 of that property, so when it gets destroyed, insurance pays us $300,000. Now we have a gain of the $220,000, the difference between what our basis was and what the insurance proceeds were. It's as though it was income to us, because it was income to us. Just like if somebody bought the property from us for $300,000, we'd have a gain from that. All right, this is the form where the business, what it looks like. I don't think you have any problems. I shouldn't say that. I don't know if you have any homework problems that involve business losses. Questions? Okay. This is kind of a short one as well. Hobby loss rules.